Hey everybody, welcome back to the channel. This is the Amit Courageous Show. We have Sasha Yanshin on the podcast today. Super excited to have him here. A lot of you guys may know him on YouTube. Phenomenal YouTuber when it comes to stocks, investing, finance, and just being able to talk in front of the camera for 10 minutes straight and get people's attention because he knows what he's saying and he knows what he's talking about.
That's very kind. Thank you, Amit.
Sasha, thank you for being on the show. I appreciate it. I want to start off the first sort of question with why are you doing stocks and investing content on YouTube?
That's a good question. It has so many different facets. This question has a much longer answer than you would think. So I have worked in the financial services industry for most of my career, with a few kind of departures along the way. But a lot of it was in retail banking, but especially towards the latter part of my career, as I got to more senior roles and I ran my own strategy consulting firm for 7 years. Yeah. I progressively did more and more work in sort of setting up new businesses for people. So like new credit card companies, new retail banks. So in the UK, there's been a flurry of new banks getting banking licenses, and we were the guys behind the scenes doing like the work for many of the ones that people know, some of the big names. So we've done a lot of work in the Middle East, quite a few big pieces in the US as well. We kind of did a lot of work in mergers and acquisitions when people were buying and acquiring other companies, stuff like that. And so I kind of progressively went from building models, and so I was always working in strategy, risk, different kind of mathsy functions. I studied maths at university, and I progressively kind of moved from doing that stuff to sort of the more macro, the more like valuing businesses and companies, and primarily in the financial services sector, although like there was a few other not quite things. And obviously that is very, very different to valuing a business as an investor, because you have completely different access to information, completely different like amount of time and resources available to do the valuation. But it was kind of interesting because we were a very niche consultancy that kind of did really interesting work. And then a combination of different reasons happened in roughly beginning of 2020, where, well, in the UK, we had a sort of Brexit immediately followed by the virus, which for a business that is like international, lots of work in Europe, etc., is not a great combo, especially an innovation-led or like, big new play kind of led business where all the banks suddenly go, wait, we're not interested in cool new stuff. Right. We're just trying to survive here. And also just, I never liked consulting. Like pretty much the day I started the consulting business, I didn't like consulting because it's just like, I'm a doer kind of guy. I like doing stuff. And the consulting business was very much a sell it. So if you're a senior guy in a consulting business, 80-90% of your work is selling. And I suck at selling because I'm not like the bubbly going out for dinner, like that kind of guy, right? So I had to learn. Right. So anyway, so eventually kind of I realized, well, actually what I want to do is kind of teach people stuff, help people understand stuff better, that kind of thing. And then I started YouTube, and I also started some other content businesses that probably just not that interesting for this. I've got blogs and stuff in other spaces. And I decided that it would be quite exciting to kind of talk about all these topics. But early on in my channel, I was really, really bad. If you watch my content now, you can kind of tell that I'm like maybe not like a natural, outgoing, out there kind of guy or whatever. But at the beginning, it was like a rabbit staring at the headlights of an oncoming car. I had my like phone precariously placed on top of some books. I have like a slightly better studio setup now, but it was horrific. And so I took the time to try to learn how to do it. And I started intentionally talking about very different topics. Like it was very, very niche. It was about UK credit cards, then UK bank accounts, etc., etc. And it was intentional because I made videos on topics where I was the only video on YouTube about that topic. Right. So even though I was really bad, people would watch my videos because there was no other ones to compete with it, right? You're going to try to make a video, like the problem a lot of YouTubers at the beginning make is they try to make videos that compete with the big guns because they're like, well, it's working for them, therefore I should be doing it. Right. I'm like, that's like YouTube. It's a bit like a multi-table poker tournament. I don't know if this analogy will probably get lost on most people, but the strategy you employ like at the beginning when you're starting is very different to the strategy you employ when you have like a few hundred subs. should be very different to a strategy you have when you have a few thousand subs, which is entirely different to the strategy. So you kind of have to adapt. Like, you can't do the same thing that worked at the beginning later on, because then your channel will implode. And I've seen lots of examples of that happening, and vice versa. So it's one where you continuously have to adopt. And yeah, here I am a year and a half later.
Was the idea of I mean, you have 50,000 subscribers at the time of doing this. Was the idea of that's like almost a football stadium. Was the idea of a football stadium of people care about your thoughts on whatever topic it is? Was that attractive to you, even from a narcissistic perspective?
Not really, if I'm honest. Like, I sometimes take a step back and look at the numbers, but the truth is that it's very kind of the numbers of viewers are sort of like mathematically interesting to me, but it's, I don't know, like, I'm kind of more interested in the business side of things and the massy side of things and the helping people side of things. That's probably the thing that I genuinely get most interested in. Like, I do videos that promote thought a lot of the time. So a lot of my videos, well, I do slightly different ones, but some are news, current events kind of things. Some are much more educational, but in almost all of them, especially on the news front, I try to kind of like often challenge the established perspective or the definitive narrative, where I feel that maybe people are like missing something, or maybe people are often misunderstanding particular topics.
Right.
And it's kind of the problem with this whole finance space is it's very dry kind of space, right? Where you try to like explain topics that are really boring. I mean, like, why do people watch my videos in the first place, or any other finance videos? It's just
good
boring,
point,
right?
It's like CNBC is really for older people that don't, it's a different.
Yeah, and it's like, so and so I'm trying to, I guess, like, push people a little bit. So what that means is it probably rubs a lot of people up their own way sometimes, and I probably like annoy some people by the nature of what it is. But the intent is that I think like they kind of look at the topic in a slightly different way, because quite often people just kind of say, well, this is obviously the thing to do, and they don't really think about it. Anything from like pension arrangements to like the way to think about investing in businesses, like outlook on stock market ups and downs, etc. Just a slightly different point of view.
Do you have a sort of macro level focus of one day, not to focus on vanity metrics, but you would like to have 1 million subscribers one day and truly be one of the main voices in finance YouTube? Does that matter to you?
If I haven't retired before then, like, it would be nice at one day, but hey, I mean, like, I'm just taking it one day at a time. It's like, right, I'm literally just taking like what video we're going to do today, like do research, make a video, put it out there, reply to as many comments as I can, go and research the next video. I've got a bunch of work with my blogs, a bunch of work with other stuff. I'm just like just trying to run as fast as I can in the treadmill, and we'll see what happens. Like, the intent was always not to game the algorithm, not to try to like optimize particular things for like a computer, but always just to try to offer like genuinely like the best content that challenges thinking, challenges people to really think on particular topics.
Right.
And like the hope is that if I do that enough, then eventually like things will go your way if you're doing the right thing and you're trying to offer better like information than other people.
Right.
That's pretty much it.
Speaking of things that challenge the status quo, Palantir, a company that I have a heavy position in, that I'm very interested in, that your audience may be interested in, and my audience. Why did you first initiate your position in Palantir?
Well, I initially was buying relatively early on after they went public, just because I felt the price was relatively good for where the company was headed. It's kind of weird because with Palantir, I have a relatively positive outlook. Probably not the sort of like it's going to the moon, it's going to become the next biggest AI company in the world, it's going to like destroy Google or whatever. Like, there's a lot of, with every investment that I make, it's kind of frustrating because like I frustrate the bulls, if you like. I hate the term, but the bulls in that space, because I am like super pessimistic in their opinion, but I'm also like completely the opposite perspective of what all the bears think about the stock. Right. And I think that the major difference is that I kind of evaluate the risks a little bit more and appreciate the risks. Like, I recently made a video about Palantir where I literally spent the entire video highlighting all the actual like serious risks that the company has, because a lot of the time when I see people like have a negative view on a company, the stuff they say, like like there are negative things about every company, but the stuff they say is often like complete rubbish. And I was like, well, it's annoying that the narrative, even when they invite people on CNBC, like, like say something negative about Tesla, and they just like completely make stuff up or say complete blatant lies or just like completely irrelevant points. I'm like,
grossly overvalued. I just feel it's grossly overvalued.
I can make like a 20-30 minute video just listing you massive problems that Tesla genuinely has as a stock. And they will be genuine problems, and Tesla's my biggest position. And it's like, it's one of those where with every stock there's an issue. With Palantir, the reason I started investing is because I felt the value was there and the risks were like good enough for me to put my money into the stock. And despite those risks, it's like with an earlier stage company like that, it is always a bit more difficult, especially with a company which is B2B and where the relative like information available about the actual product is like super restricted. Like, 60% of Palantir's revenue comes from US government and US military at the moment. And putting, understanding in any real depth what exactly that software looks like, what exactly the competition in the space is nigh on impossible unless you are working for those governments and you get approached and you kind of regularly speak to potential providers of that stuff. So compared to some other companies, it is more difficult to value. So you're kind of valuing top down, you're kind of looking at their metrics and saying, okay, this is how I'm going to project, but you can't really do a very effective bottom-up model. You can't go and say, oh, well, my model says that next quarter, they're going to sell to these specific clients. And in my model, I reckon like this client will pay $12 million and that client will pay $25 million. It's very much you partially blind in the data space compared to the other companies, but I felt the upside was strong enough in terms of a very unique space, and it's kind of like people don't understand the company, like you say, but it's also an incredibly simple thing if you actually like. People kind of say all kinds of weird things, but it's just a place where you aggregate data and kind of analyze it. I mean that's it. It's like if you work in anything to do with data, it's like you have, you run a website or whatever, you have your Google Analytics data by the website, you have some metrics about some sales you have over there, you have some completely unrelated data that like the problem that most organizations have is they have huge amounts of data, but they can't do anything with it. And all Palantir is doing is basically building a very sophisticated piece of software that makes it incredibly quick and simple and relatively seamless to merge all these pieces of data together and then allow anybody a sort of a pretty much GUI way of like clicking, point and click with a mouse, of being able to analyze it and do stuff with it. So data that previously was, would take an analyst a few months worth of work to merge and properly clean and do all that kind of stuff to do a one-off piece of ad hoc analysis, they can go and allow companies to analyze and pick up things that would never previously be picked up, like relationships, like for airlines, where they can know based on the data in all the sensors available on a plane, that when the combination of those sensors data begins looking a bit more like this rather than that, that means that this particular part is going to fail at some point in the near future. And so that you don't have to cancel flights, etc., you might as well replace it next time the plane lands. Things like that, which save huge amounts of money, save huge amounts of time, are extremely effective, but like nobody's really done that level of data aggregation analysis before. And I think it has quite a big moat around it, where replicating is not necessarily like a viable business model, because it's one of those where once people are on the platform and they're using it and it does everything and it does it well, it is relatively difficult to then displace.
Right.
Like I can go and create another platform that could theoretically be as good as YouTube tomorrow, but nobody's going to go on it because everyone's on the other platform already. And why would you go to something without there being a really good reason? Right. I'm waffling.
No, that makes sense. You did make a video the other day about all of sort of the harsh reasons why Palantir could fail. If you had to isolate one of those as like the biggest risk factor in your mind, which one would that be? I think you mentioned they get their money from the government, the sort of SPAC stuff that could fail.
I think the two biggest reasons. So the biggest short-term reason for me is the concentration in clients, and like it was one reason together that I bundled the concentration in like a small number of high value clients, plus the lack of evidence so far that they can penetrate the sort of like smaller business through to retail markets.
Right.
Because we haven't seen anything really in that space. There's talk, and they're saying we're getting, but we're still talking about like their contracts in the millions, tens of millions. So we're still talking about large companies here.
Right.
So in the short term, it's probably the biggest risk. Like not necessarily a risk of collapse, but a risk of stagnation. And because the valuation is so heavily based on growth, like any prolonged stagnation for a few quarters, where, for example, like let's say a few big contracts don't go their way or whatever, somebody cancels, doesn't renew, like that could have a pretty long lasting impact on the share price, where people say, well, people are going to, for a long time after that, kind of say, well, the growth is not guaranteed. Look, there was a moment when X happened. It's probably the biggest short-term risk. The biggest long-term risk, I think, for me is the pace of technology eventually displacing them, just like they displaced whoever was providing services to the people they're selling their services to.
That was one of the most interesting ones that you talked about.
Because I think like people kind of forget the fact that like we do evaluations in 5-10 year increments, sometimes longer, whatever, right? But you kind of think about like do you remember what technology was like 20 years ago? I mean, like, oh my God, like the leaps. And it's kind of easy to think, well, these guys are at the forefront now and they're miles ahead and they're gonna stay miles ahead. Yahoo was miles ahead 20 years ago. Like
now they're Yahoo Finance. I mean, at least that's relevant.
but this is like a really important point. It's like, yeah, they're miles ahead. There's nobody even remotely on the horizon. There might be some small startups trying to disrupt or whatever, but like, hey, completely different. Like technology has this way where when there is a massive leap in tech, whatever it is, maybe like new generations of processes that make like the way that you structure data and interact with data completely different. Other stuff, which just means you basically have to kind of do a ground up rewrite, even if you are the market leader. And eventually there'll come a time when, I don't know, it could be in 5 years, it could be in 50 years, eventually there will be a time when some new Palantir will come and kill this dinosaur Palantir, and make them relatively relevant and offer the US government a massive incentive because of what they offer in the product, right, to switch. It has to be a massive one, but eventually, and overnight you go and lose like most of your business. Like, it's not going to work out very well for you. Like, this will happen. Right. The question is when it's going to happen, because it happens to every technology company in history. Like eventually IBM is the technology company will die. Well, the IBM is the most kind of relevant in a way, but it's like technology shifts and changes, and you have, like, sure, they have a bunch of really smart people, they have a bunch of extremely sophisticated technology, and they're continuing to innovate to stay ahead of the game. But the time will eventually come. No, even though Palantir is one of my biggest positions, you just need to be, like with any company, I think the key is you need to be aware of the risks. You need to be just like knowledgeable. You need to understand that the risks exist rather than negate them. And I always get frustrated when people just, when they believe in the company or they invest in the company, or whatever, they just brush it. It's just FUD. It's just like, just stop saying this stuff. It's not relevant. I'm like, or like it's not true. I'm like, well, it is true. Like, every investment has downsides. Yeah. The first sign that somebody doesn't understand their investments is if they claim there are no downsides.
Right. It's not an investment at that point. Okay, next question. Are you a growth investor or a value investor? And what do you think that means? And do you even think that's a fun question or a stupid question?
It's a good question. I think the two have a massive overlap. And I think I am both a 100% value investor and both 100% growth investor, but not necessarily at the same time. So to me, the difference between them is like, I mean, it's very, like, in my mind, it's relatively straightforward. I'm not the sort of the dictionary definition guy, but value investment is just investment in my mind, which is you're trying to optimize by putting money in companies that you feel are particularly undervalued, where you feel that the consensus, which is the current share price, is considerably lower than what you feel a fair price for that company is.
Right.
Like that's it. That's what the value to me investing is. And growth is something very different, where you're investing in companies that you feel are in the early stages of the sort of business life cycle. So if you have that S curve of adoption or whatever, you're sort of like below the point of inflection somewhere. And the further away you are from the point of inflection, the more kind of growth the stock is. And typically, like, the point of inflection comes just before or roughly around the sort of break-even point for most companies. And so you can have growth stocks that are value stocks, but you can also have growth stocks that are massively overhyped. Like, for example, like recently in the last few months, we've had like Rivian go to $160, $170, a valuation of whatever it was, like 70 billion. I can't really remember how many tens of bit. It's just like mind blowing, where a company that's like sold 3 cars to marketing promotion people, and real customers are still waiting until at least the like Q2, I think, at the moment. So I think the cars they've sold so far are basically just internal and press and marketing and stuff. And like that's a growth company, but it is very much not a value company for me at the moment. I think it will be very difficult for someone to structure a mathematical argument as to how that's a value stock. And there are value stocks, like there are mature companies that can also be, for whatever different reasons, massively undervalued. So they're not growth stocks, but they're value stocks. I guess, like, ultimately, I guess I'd probably predominantly invest in the overlap of the two. The reason being that the upside, so the difference between the current price and my assessment of what a fair price is typically higher for growth stocks than it is for mature stocks.
Right.
And I'm happy to sit, waiting for that upside to materialize, but it's usually like considerably higher. Like on a mature stock, you can have a decent upside of 15 or 20 or 25, 30%. On a growth stock, that upside can easily be over 100%. And that, like, not be ridiculous, that not be something really stupid sounding. Right. Obviously, there's far higher risk on it. There's far longer time that you have to wait. There's going to be a lot more volatility around it. A lot more of those businesses will fail. But I kind of feel that, like, I am more interested in valuing those business models than the mature stuff where you're just playing on value margins.
Given you say a lot of them will fail, is your hypothesis to obviously make sure your investments don't fail, to just do enough research to pick the ones that have a higher than 80% chance of not failing? Because you can't pick all of them. So, like,
well, you don't need necessarily like a high, like you need to be right sort of most of the time, but not all of the time. And this is one where, like, I would be delighted with a 25 to 30% annual return on my investments.
Right.
It's kind of like one where everyone who is in the crypto sphere right now is like, you can be poor, you suck, man. I'm not here to collect 1,000% in 3 months or whatever. That's not my objective. And I think that people can be somewhat deluded in kind of thinking that is somehow normal or somehow a fair expectation. So I'd say that,
like, you minimize the downside by doing enough research on the growth stocks and just have to do it a couple times.
Sure. So you have to do 2 things, really. You have to be really quite careful with assessing. I don't really talk about this much in the videos at all. The reason I don't talk about this much in the videos is I think it would be extremely difficult to explain in a YouTube video to a point where, like, it doesn't become a massive bore fest and nobody watches it. But you have to be very careful with assessing the risk profile of your outcomes.
Right.
So you can have, like, this is my sort of like my base, my sort of mean, like my sort of like average expectation. But what do you think is sort of the realistic, like, top bottom quartile kind of ranges? What do you think, like, the deviation around your potential outcomes is going to look like? How likely is it to actually go to like 0? How likely is it to go like way beyond anyone's wildest expectations? Like, how do you even make that assessment as to what that likelihood is? Some stocks is maybe a bit more difficult than for others.
Right.
But then also the second bit is you have to be really hard on the qualitative assessment. And this is one where, like, most of the stuff I hear online, like, either ignores or, like, the assessment is very superficial. It's like, I believe in this business or something, or like I trust in. I'm like, that means like nothing. It's just words. Like, have you researched like specifically, you know, like the backgrounds of, like, for example, like I make very few investments in really early stage companies, but like earlier this year I was making quite a big investment in Lucid, made a video and that happened, etc. And qualitative assessment was the biggest driver of why I made that, because I was investing at like $16, saying I think this is pretty cheap. Like, I was like, I think this should be about a $41 stock. And then I sold everything at $41 a few months later. I didn't expect it to quite be that quick. But that valuation was really heavily based on the qualitative assessment in terms of, like, you know, like, without going too deep in it, you go and look at the profiles of all the senior guys in the business, like extremely robust. You go and compare that to, like, say, I know a similar company in a similar space, like go and compare like that to Nikola. I'm like, it is very different. Right. Go and compare the manufacturing facility, the factory, like the actual videos and pictures and stuff of inside the factory. Have you seen those recently, like Monroe Live doing a video of inside the Nikola facilities, where it's like a giant shed with like 5 people gathered around a table? I'm like, this is not a factory.
Right.
But like, you just look at the technology, like what backgrounds they have, what have they already got, what are they currently working on, like all the different little snippets of information you can glean. Like, you need to be quite thorough on that. Right. That's the second biggest bit, I think for me.
We have a market that is selling off right now in 2022. Are you in the camp, in the school of thought of the Cathie Wood of the worlds, or the Cathie Woods of the world, that basically say inflation is transitory, supply chains are getting better, the Fed is being hawkish for no reason, and innovation will be deflationary? Or do you think it is absolutely vital to have interest rates hikes and really slow down the pace of growth that's happening in the economy?
Well, I think the government has put themselves, like, they kind of did this to themselves. They put themselves into this no-win situation, right? Where realistically, they're going to have to increase rates at some point. And it is impossible to tell when they're going to increase the rates. But they're going to have to do it at some point. The problem is that they've now issued all of this free money to people. They know that a bunch of people and entire industries are massively over leveraged. Yep. So the moment you go increasing rates, you're not, like, I think everyone's saying that they can't increase interest rates because they're going to shoot themselves in the foot because they've got all this debt, the government debt, and the rates on that debt's going to go up, blah, blah, blah. But that's relatively irrelevant. That's an academic argument. The US is not going to go bankrupt anytime soon.
Right.
The US dollar is the reserve currency. We trade everything, oil, everything in it, like the whole world. Like, the US government and the dollar are not disappearing or going away anywhere. The real problem is that the moment the interest rates begin going up, is they're going to be killing off like huge chunks of the economy. Anything in the hospitality sector, anything in the retail sector, anything in not everything, some of the things in the retail sector, a lot of things in the travel industry. And that's going to have like far-reaching repercussions where, you know, like a lot of major crashes are caused by like one particular sector being in a hotspot. This could cause a really big recession that would last a really long time. Because, you know, like, people are, like, a lot of these organizations, a lot of people, like, some personal debt has been paid off, which is good during this, but that's the average. And what people are kind of forgetting is that while the average is good, it kind of means like a lot of the people with more income are paying off like low risk, low cost debt. But the situation with people who are on, you know, who've been displaced from jobs, who've been on furlough, unemployed, etc., through all this period, like, those people, like, sure, there's been a few like checks that were given to them to get them through, etc. But in the grand scheme of things, like, their financial situation is considerably worse, and increasing rates just means that debt becomes unaffordable. They begin defaulting on the debt they have. I think the problem is that's the situation they put themselves in. But if they don't increase rates, inflation has a bad habit of sort of running all by itself. Inflation is like this fire where usually you need some kind of like fuel to start the fire. But once the fire started, you don't need the fuel to keep, because people are like, well, they're going to stop quantitative easing in March. And it's like, right. So it's already running. It's already going. It's already up to 7% and running. It's the highest it's been in 40 years. And it's like the pace at which is going up is insane. The only reason we only saw 0.2% increase in the last month rather than more like a 0.8% increase is because oil and gas were, like 20 and 10% down. I can't remember if I got this the right way around, in December versus October, November. And they were also both about 5% up in December 2020 versus the previous 2 months. And energy has a 7.5-8% contribution to the consumer price index directly, plus probably, depending on how you look at it, another, I don't know, like 10% indirectly through everything else that also uses energy. So the fact that like there was a massive price differential there suppressed the numbers yesterday, and everyone celebrated, like, you know, everyone celebrated 7% inflation. I'm amazed. So the problem they're going to have is, like, the longer they wait, the more gruesome this problem can become. There are very, very, very few examples in history in different economies, including the US, of inflation just going away by itself.
Yeah.
Certainly in modern history. And people can say, well, people strike these new economic theories, which could happen. Things do happen for the first time all the time, right? This could be an unprecedented new thing because of coronavirus, blah, blah, blah. We have an M2 money supply that is like 5 times what it was before the beginning of last year, which is insane. This could all go away by itself, but if you look at the last, like, the history of, like, 20th century through to today, like, it has never gone away by itself.
Right.
And the only reason it does go away is when you raise rates. The rates go above, that pushes downward pressure on inflation because money is being devalued faster, and therefore, like, prices have to begin dropping relative, you know, in absolute dollar terms, even if they're still increasing in relative dollar terms. But so that's the only way you're going to squash, like, that. Traditionally, that's the only way it's worked. And we have seen examples previously in other countries. You know, everything, like, even in the last 20, 30 years, we've seen it happen in Yugoslavia, we've seen it happen in Russia, we've seen it happen in the Middle East, we've seen it happen just last year in Turkey. This happens all the time, like Venezuela, etc. Like, there are countless examples where if you don't take the appropriate action, which is managing monetary policy in a appropriate fiduciary way, like, things can get out of hand quick.
Right.
And it can look kind of okay until it isn't. And this is a big problem. Like, we've never had, I haven't looked back to before the Second World War. We haven't had since, like, the 1940s or 1930s a situation where the interest rate was, like, lower than the inflation rate by any reasonable amount for any prolonged period of time, like we've got today, like, not even remotely close.
So are you saying we would have to raise the interest rate to above 7% to have a meaningful dent to make this
yes
work? And that's not going to happen, right? Objectively.
Well, it's not going to happen for now, and that's only going to exacerbate the problem unless we have a first one of a kind kind of situation, which could happen. There are arguments for it, which is, the fact that the US dollar is now used, like, US dollar has become a kind of weird thing where it's always become like a beyond currency where it is used for far more than just, like, the functions of a currency. In global trade, in global agreements, in being used by other countries with other economic situations, directly or indirectly. And that does mean that, like, the impact is likely to be different. But at the same time, that was also, to some degree, not to this degree, but to some degree, the case in the 80s. Right. And in the 80s, we had inflation go to, like, what was it, 15% or whatever. Yeah. It was going up more slowly than it is now.
Interesting. So maybe there would be a Paul Volcker type of renaissance that we may have to have. Yeah.
Well, we're already seeing, I think that the problem we have is that the SEC and the Fed and everyone else, in different ways, are just playing politics.
Yeah.
And the Fed in particular, they're kind of saying, okay, well, we're not going to be raising rates. Like, inflation is transitory. Oh, wait, maybe it's not transitory. Okay, we'll probably have to increase rates a bit faster. In November last year, 2 months ago, the official position of the Fed was that the first interest rate hike was probably going to come in December this year. We're now in a position, as of 2 days ago, I think when Powell said that they're now saying we will probably start increasing interest rates in March and have 3 increases of 0.25%. So you can already see them, like, in 2 months, it's moved, like, relatively quite a long way.
Right.
and this is the thing, like it kind of sounds impossible that we would see like any substantial increases in interest rates like later this year, right now, because of the official rhetoric. But that official rhetoric can quite gradually move, and like, from 3 increase of 0.25, we might see 4 increase of 0.5, and so on and so on. And that is, I would say, a relatively likely scenario.
If interest rates going up hurt growth stocks, the stocks that you and I are interested in, and their prices get decimated, do you think that interest rates going up March, April, May is going to hurt these stocks even more than they've already been hurt, down 50% from their highs of last year?
I think it probably will hurt growth stocks, but I think it will hurt growth stocks only in the superficial way of having the stock price go down. But I think people generally, and this is like just also interesting from just an academic point of view, people generally read, and the market overall really overvalues the impact of interest rates on growth stocks, especially like a lot of the growth stocks that I'm interested in. Not depends on the level of commoditization, the type of product or service the stock offers.
Right.
Like, for example, it'll probably hurt Palantir a bit more than some others, because a lot of Palantir's contracts agreements are long-term, multi-year contracts where you sign a contract today that maybe in 4 years, the money you collect according to that contract is devalued by 25, 30, 40%.
Right.
That's a problem. And you have to execute, and it's taking your resources, etc. You go and look at a company like Tesla, they increased their car prices by like over 20% last year, within the year. What do you think is going to happen? Like, if the dollar tomorrow is worth 20% less, they're just going to charge you more for the car, like overnight.
And they can do that because they have the demand.
And they can't do that. They have demand and far outstrip supply. Like, same with, for example, like one position that I have that is relatively big for me is Fiverr, a very small company, not very popular in investment circles. They've been hit very hard recently because of the inflation, primarily because they're like very early in that S curve. Like, they're even in my model, like, I don't know, like 5 years from breaking even or something. So because of that, like, people are very scared. But I'm like, what do you think is going to happen if inflation happens to Fiverr? Fiverr earns money as a percentage of the earnings of the people who work on it. So if tomorrow, if things cost 20%, guess what? Those contractors are going to charge you 20% more. Yeah. And Fiverr's going to make, like, so it's a bit like your model might be wrong, but your model will be wrong like in the same way on the factor by which you're discounting,
right,
as it is in the rate of growth of like the revenue per user or per whatever. Because like a lot of businesses out there like are more nimble and are able to raise their prices considerably more quickly.
Right. And for a business, like, one of the things you brought up about Palantir is that they collect the money a little bit later. One of the good things about them is that they have no debt. So does a growth stock that has no debt right now, does that help them because they don't have to borrow money, so the interest rates don't affect them?
They do, but it's also really relative, because there's debt and then there's like serious debt. So you have, like, say, for example, some of the large established car makers who are so burdened with debt that if interest rates were to go up to like 10%, like, the likes of Ford and GM are screwed, like, big time. They would have a lot of their cash going towards funding that debt, just maintaining it, let alone repaying it. But in the growth stock space, I think like the rate at which a lot of these guys are growing and the cash they're bringing in, sort of having no debt versus having little debt is somewhat immaterial. It's a bit like, like say Tesla at the moment has what, I can't remember what the number is it 6 billion, 7 billion? I can't remember what the latest number is. Maybe I'm wrong on that one. Whatever it is, I'm like, the company generated like 12, 13 billion in revenue last quarter. They're probably going to be generating 18, 20 billion for Q4. They're probably going to be generating like well in excess. So like that number relative to that growth is not really that important, because the rate of growth is far outpacing anything we're going to be seeing on rate increases, even if they're aggressive.
Right.
And so like, it'll cost them a bit more money, but it's not going to be a killer for like, most of these kind of companies are not grossly over leveraged, because typically it's very difficult to get grossly over leveraged on debt as an early stage company.
Yeah, that would be a little bit insane and absurd. To end it off here, does that mean that you are conservatively optimistic about buying this dip before we have an interest rate hike? Or are you like, look, I don't know how the market's going to react. The market gets crazy when an interest rate hike happens. I will buy
I'm very,
when that
yeah, I'm very optimistic. I'm very optimistic about buying the dip. And it's one of those where like my outlook is like what I say in videos, like literally when I say something in videos, like what I actually do in real life. Like I'm sitting here like 5-10 years at least, like for my investments on average. Hey, if another lucid happens and I get like 3 times my money in a few months, I'm going to cash out. Like, thank you very much. Move on to the next thing. But most things are not going to happen that way. Most things will take the time. And I'm like, well, I'm happy to sit it out. And it could be that we're going to trade sideways for a year or 2, maybe
even
3.
more.
I don't know.
Even longer. Yeah.
It could be that the stocks will fall from here. I don't know. Nobody else does. I don't have a crystal ball, but I only value things based on, so I make like the best possible assessment of what my fair target price for the stock is based on the data that I have. I look at the current price. If there's a massive upside, I buy. The kind of like parable I use sometimes is you go to a shop and you see your favorite chocolate bar, and your favorite chocolate bar is like being sold at 50% discount. Do you buy it because your favorite chocolate bar has got 50% off, or do you not buy it because you think that maybe next week is going to be 70% off? I'm like it's a good deal to me. Like it's a good deal. I am happy buying. Like maybe it will be, maybe it won't be. If it's 70% off, I'll try to find some more money and buy it then as well. But I'm not going to try to time it, because on average, mathematically, when you do try to time it, on average, you're going to lose money. You're going to lose quite a bit of money.
Yeah.
So yeah, I might lose this time. This is one of those kind of things in investing. You get all these comments like, you bought Fiverr and Fiverr is down since you bought it. I'm like you're referencing a video from 2 months ago when I'm talking about a 10-year model. Like, so what? Like, I literally don't care. Like, sure, it might not play out in the long term, and that will be a mistake. There'll be a loss, but you have to, like, everyone's going to have losses. Nobody has a perfect 100% investing record. The key is to balance it over time so that you average out at a good number, and that's what I'm after.
I think that's a perfect way to end it. Thank you, Sasha, for being on the podcast.
Thanks, Amit. Very good to be here. Really appreciate it.
Yep. Thank you for sharing some of your insights on YouTube.
And good luck.
And investing.
Good luck with your channel. Yeah.
I appreciate it. All right, Sasha. See you next time.
Bye.